Hey guys, so today I want to talk about investment portfolios, and really this is kind of what you would get if you went and sat down with a financial advisor. But I think it's important that you understand a few concepts so we can get into my models that I'm going to teach you about on how to hedge using options. So let's first take a look at what we call efficient frontier. We have reward on the vertical axis and risk on the horizontal axis, and the more return we expect to get out of an investment, whether that be a fund or an individual stock or whatever, the more volatile or the more fluctuation that's going to have. So that's a positive proportional relationship. The more return, the more fluctuation. And that's pretty much a given if you look at any investment class. So here's an example from 78 to 2010. Long-term bonds returned right here in the 9% range. Boy, that would be nice, wouldn't it? And their standard deviation was really high, almost 13%. But if you look at stocks, the S&P 500 returned a little bit higher, about 11.5%, but their standard deviation was a lot higher, which means they fluctuated more ups, more downs. That's really important. Less steady. And the reason it's important is because we combine asset classes and we get a better risk-return ratio. So government bonds actually has more risk to the right on the risk axis here than a portfolio over here that's made up of maybe 80% bonds, 20% stocks. So when I was a retail financial advisor, I would get lots of older, more conservative clients that they didn't want to take any risk at all. And it takes a long time to convince people, but it 100% is true based on the math, that if you combine stocks with a bond portfolio, it actually does better over time. It makes more money and it has less risk, less fluctuation, because not to get into it too much, but because the more assets are non-correlated, the better you can make these risk graphs work for you. Okay, so as we add more stocks, here's 40%, here's 70%, so this would be 70-30, and then all the way up to 100% stocks, your risk is increasing, but your return is increasing. Here's another example from a different chart. You know, here's 5% stocks, 95% bonds. Basically has a little bit less, almost the same risk as 100% bonds, and then as you move up, your return increases quite a bit with a little bit more risk, and then we kind of flatten out and we get almost a linear relationship between more stocks, 50%, 60%, 80%, and 100%. You're getting more return over here on the vertical axis, but also more risk on the horizontal axis. So what does this matter? Well, when you combine assets, you can shift this whole thing up because of that correlation factor. So a portfolio of funds that has some small cap, has some mid cap, has some international, has some real estate, has some commodities, maybe even nowadays has some crypto, Bitcoin, some type of exposure to that. When you combine all that stuff together, they don't all move the same. So overall, in general, your overall portfolio is going to have less volatility, and that's what we see here. So if you actually have a portfolio of only stocks and bonds, which is the red line here, okay, you can get the same return if you have a portfolio where you add real estate and you add small cap value stocks. So over here, this is left of this point on the horizontal axis, so you've got less risk, meaning less fluctuation, with the same return. Or you can have the same risk, the same fluctuation, with a higher return. And that's the way these efficient portfolio graphs work. And it's all about combining assets. So when you go to a financial advisor, what they're going to do is they're going to suggest to you a model of funds, of mutual funds or ETFs or some type of model that does just this, that combines it. And I've got a couple examples here for us to look at. So this is American funds, a very good fund family, have been around a long time, have long-term track records, and just a very solid company. So this model is called the American Funds Growth and Income Model Portfolio. It's got a whole bunch of their funds, but if you look right over here, we've got about 80% equities, 58% of that is U.S. equities, 21% is non-U.S. equities, and then fixed income is about 16%. So, and cash is 4%. So I'm going to call this an 80-20 portfolio, 80-20. So 80% stocks, 20% bonds. So if we go back and look, you know, on this graph somewhere. It's kind of, up here on the risk side, not 100% stocks, but pretty much a growth-oriented portfolio. Okay, so how did this do over time? Well, I think this flyer shows us 10 years. So this is your expense ratio. That's what the mutual funds charge you to manage your money. And here we are. If we put 100 grand in 10 years, it's worth about 263. That's a 9.75% average annual return, give or take, in that ballpark. And then this is the standard deviation. This is lifetime standard deviation. I don't think it's quite as high for this time period, but standard deviation is a measure of how much it fluctuates. Okay, not to get into the math, just know that the lower the standard deviation, the more steady it is, and the less peaks and valleys, the less highs and lows. Okay, so we want to maximize the return with less standard deviation. Okay, so here we are. This is the as of September 2021. This is the portfolio. 10 years looking backwards, your average annual return was 11.7. Okay, this number 9.75 was lifetime. So 11.7% over 10 years. Okay, they charge you 0.44% a year. That's their fee. That's what they charge you to manage it. This doesn't include what you pay your advisor, because most advisors have a fee on top of this. This is just what the fund managers get. Okay, so if we look at this, 11% or so with an 80-20 portfolio. Well, let's look at another one. Here's Blackrock. Okay, Blackrock 80-20. So 10 years, 11.3%. Pretty close to the exact same. If you put 10 grand in, September time frame is probably right in here. You're looking at 28,000. That's 287 compared to the American funds, like 270 something we said. So almost identical. Okay, the fluctuation, the standard deviation is going to be the same, and there it is, 11.73. And the reason is because it's basically the same. You're investing in the same stuff. Okay, each fund can overweight and underweight different stocks a little bit differently, but for the most part, they're buying a huge basket of stocks. They're trying to make sure they don't underperform their benchmark index, and for the most part, their benchmark is the S&P 500. Sometimes they blend a benchmark. They'll use part S&P, part like a global equities index. But for the most part, they're not trying to hit home runs. They're trying to make sure they capture the market return. And that's the way long-term mutual funds work. Okay? So what I did is I went to the website here, Portfolio Visualizer, and what we're going to do is, what my goal in this program is to teach you how to hedge your portfolio as it is. So if you've got a mutual fund portfolio at XYZ financial advisory firm, and you've got American funds, or you've got Franklin Templeton funds, or you've got a mix of all different kinds of funds, what I'm going to show you how to do is take your statement, figure out what your allocation is, how much equity you have, how much fixed income you have, and then we're going to model that with a couple of these different models. And what I've done here in Portfolio Visualizer, instead of putting in a whole bunch of different funds, I've used two. Okay, the two that I've used are SPY, which represents the S&P 500, and TLT, which represents fixed income. That's bonds. That's a bond fund, an ETF. Okay, so I've got three different portfolios here with SPY and TLT. The first one is 100% stock, no bonds, no fixed income, no cash, just 100% S&P 500. Okay, then I've got an 80-20 and a 60-40. We could look at 70-30, we could look at 50-50. These are the three that kind of I'm looking at right now. Okay, so if I go ahead and click Analyze, here we go. Here's the first one, 100% stocks, and then the second one is 80-20, and the third one is 60-40. Okay, so now I've fixed this. So now we're looking at the last 10 years because I want to make sure we're comparing apples to apples. So this is starting January 2012 and ending December 2021. Now, I think the American funds ended in September, but the other one we looked at ended at the end of the year. So I think this will be really, really close. So I'm going to analyze 100% stocks, 80% stocks, 60% stocks. So let's see what we got here. So the 100% stock portfolio, 16%. The 80 was 14%. The 60% was 12%. So why are these numbers slightly higher? Well, one thing is because of expenses. More than likely, the expenses cause a little bit of this, and then the funds could possibly underperform a little bit just because of they're not tracking 100%. So the S&P, usually an index fund or just an S&P 500 ETF usually beats mutual funds. Okay, but the standard deviation is higher. Okay, so you've got more risk, more fluctuation. The more bonds that you add, or the more fixed income, the lower your standard deviation. Now, I could get really fancy with these, and I could add real estate. I could add, commodities, whatever. Those are called non-correlated assets. I could build portfolios in here just like that. I don't care about that right now. All I want to do is build something that's very close and representative of any mutual fund portfolio that you would have. Okay, so whether you manage your money yourself in an account that you do yourself, or if you have an advisor, I'm going to give you a proxy that you can use, and we're going to use options to hedge it, and that's what this video is about, to show you kind of how to set that up. So, but here's the interesting thing. Okay, look at the drawdown. The max drawdown for portfolio 1, which is 100% S&P 500, was 20%, 19.5. So, is that bad? Well, could you make 16% a year knowing that your worst drawdown from peak to the bottom was only going to be 20%? That's not a bad trade-off. I would probably make that if I had a crystal ball and I could look forward 10 years. Okay, but down here, even with portfolio 3, 60-40 bonds, you made over 12% a year, and your drawdown was only 7%. That's incredible. That's really good. The last 10 years have been spectacular. Okay, I mean spectacular. So the worst year for the full S&P 500 was down 4%. I mean, that's incredible. So let's rewind and see what it might look like in a different time period. Okay, so if we look right here, this is a picture of the drawdowns during that time period, 2012 to 2021, the last 10 years. And, here's 6%, here's about 7 or 8%, here's still less than 15. We had one drawdown, and this was COVID, in early 2020 of almost 20%. This is measuring month ends. Okay, so this drawdown was actually worse than that from peak to trough, but this is just looking at rolling months. Okay, so, well, if we look right here, I'm going to say that was about March or February 2020. Yeah, it was only down 12.5% for March 2020. Okay, that was the month end. So, so nothing crazy there. Okay, nothing crazy. But let's change our dates. Okay, so instead of ending in 2021, let's go from about 1999 to the end of 2008. Okay, again, that's 10 years. So that's starting in January 1999 and ending in December 2008. Was anybody around and remember what happened in 2008? So here's your S&P and your TLT. Still got 100, 80-20, and 60-40. I'm going to hit analyze, and let's see what it looks like. Okay. Your S&P 500 return, 100%, made 1.76% per year for that 10-year period. The worst drawdown was 40%. Okay, standard deviation was 14. Your 60-40 portfolio only made 6%, and it still had a 20% drawdown. Okay, so here's your portfolio growth. Your 100 was all the way up to, 150, 170, 180, but then it dropped all the way down. Well, your S&P dropped all the way back down to 111, and you started with 100 10 years prior. Okay, if we look at drawdowns, let me get on the right screen here. All right, 10%, that was really the worst of it, and then starting in 2008, the bottom fell out. Okay, now I would argue if you were at retirement age, let's change it one more time. Let's say that you retired right here around 2008, 2009, 2010. Let's move this up to, let's say, 2006 to 2015. January 2006 until the end of 2015. That's 10 years. Okay, so this scenario has 2008 kind of right in the middle, sort of at the beginning. All right, you averaged 7%. Your standard deviation was still pretty normal, between 10 and 15%. Look at that drawdown. Okay, so here you are, retired. Let's say you worked out with $1 million, 700,000, 800,000, whatever the number is, and it went from that amount to a lot less. Okay, now obviously it's recovered, but this is your retirement. This is when you need it. This is when you're planning on cashing in and starting to take out income. This is unacceptable. You can't do this. Okay, you can't have a humongous meltdown if you're within 5 years of retiring. That's the whole purpose of learning how to hedge. If you hedged here and you had the knowledge and the know-how, you actually could keep this flat or even have it increasing during this time frame, and then sort of getting back to normal afterwards. You'd have a ton more money than you would have just riding it out and going through. And I would argue it's even worse if you're taking money out. Okay, if you're taking money out when it's going down like this, you're killing yourself. You're shooting yourself in the foot. Now, what does an advisor do to combat this risk? Well, what an advisor does is, instead of you having an 80-20 portfolio, you'll have a 20-80 portfolio. Well, a 20-80 portfolio did a whole lot better during this time frame, I promise you, but it didn't go from here to here. It didn't recover. It doesn't grow as much, because by nature, the only way to get the growth is to be invested. So the whole purpose of what I want to teach you is to keep your portfolio invested well with a high percentage of equity, so you get the good years, but hedge it against a humongous drawdown. And the drawdown is coming. It's around the corner on the horizon. Guarantee you within the next 3 to 5 years we're going to get some seriously choppy market volatility. So I hope that made a little bit of sense. I hope it piques your interest in and it makes you ask yourself, you make a lot of sense, Chris, rather than going to a whole lot of fixed income, which right now stinks. It's not paying anything. I would love to be able to stay invested and figure out a way to sleep at night so I don't have to worry about what happened in 2008. So stay tuned, more to come. I'm going to show you what we're going to do. Thanks for watching. See you next time.